Fed Chair Jerome Powell announcing that he's going to crush it. He's going to crush inflation. He's likely going to crush the U.S. economy, and he's likely going to crush the U.S. stock markets and potentially stock markets around the world. I'm not the only one who's concerned, as you see major hedge fund just warned that hyperinflation could lead to global societal collapse and blames it on the central bank, the previous policies of ultra low policies. This is not some fly-by-night hedge fund. This is Elliott Investment Management, been around since 1977, manages over $50 billion. This is one of the big boys, folks. Only 2 years of losses in their 45-year history. They are worth paying attention to. So when they put out a warning about potential societal collapse or hyperinflation, much lower asset prices, you want to pay attention. So we're going to talk about their warning. We're also going to talk about what did Jerome Powell do earlier this week, what it potentially means for you. I personally, looking at these data points, it suggests to me much continued stress ahead, potentially a collapse in stock prices from here. Like what you've seen so far is just the warm-up act for what you could see potentially in the quarters ahead. That's effectively the signaling that I'm getting, and that's what we'll talk about in this video. But it doesn't mean just because you're facing these stresses, just because you're facing this really tough period, that, hey, you have to be hurt by this. This could be actually an opportunity for generational wealth building. And that's how I'm viewing this. I'm viewing this not only as a challenge, but as an opportunity to say, hey, let's find the best businesses I can. And what are the types of businesses I want to own for this environment? And we'll talk about that at the end of this video. So let's go on to understand, well, what did Jerome Powell do earlier this week? He raised interest rates, short-term rates, by 0.75 percentage point to around a little under 4%, 3.75 to 4%. What this means for you first is that your cash, if you click on the link to Interactive Brokers below, is currently yielding over 3%. That's way better than a lot of major banks out there. So investors are starting to say there's a real trade-off between, let's say, owning stocks versus getting cash. Another core aspect of the meeting earlier this week from Jerome Powell is effectively he said, look, interest rates are going to be higher for longer. It's not necessarily about, that we might do 0.5% next month or 0.75%. We're going to do what it takes. We're going to keep it higher. Maybe it's around 5%, maybe it's over 5% to break inflation, because he is committed to that. He's going to keep at it until he breaks inflation. That's a key aspect. So even as you see unemployment potentially start ticking up, he's going to keep interest rates high. The last and most important data point from earlier this week, what Jerome Powell had to say, was he effectively said, I'd rather over-tighten, that's exactly his words, versus loosen too soon. This is super important. He's effectively saying, I would rather crush the economy. I'd rather put rates too high, causing real pain, higher unemployment, because getting inflation under control is so important. So he would rather sink the economy, crush it, and then have the option to lower rates, maybe even print money again, to sort of offset it. Because if he doesn't address inflation now, you're potentially looking at even worse medicine 5-10 years from now to deal with entrenched inflation as it sort of gets stuck in the economy and sort of bounces around from sector to sector. That's effectively what he's saying. I'd rather over-tighten versus loosen too soon. That is just tremendously important to understand. And I think this ultimately leads to much lower prices for the stock market. And as I said, I'm not alone on this. Now, why is this such a big deal? And why is, let's say, a major hedge fund like Elliott worried about hyperinflation? Well, let's look at the U.S. government. Currently, net interest expense on the U.S. government debt is around $400 billion a year. Now, the Congressional Budget Office says based on their forecasted, these are their numbers. These are their, I'd argue, very lenient numbers. They're effectively saying the interest cost on that debt is going to go from $400 billion to $1.2 trillion a year. That's quite a bit. As a percentage of revenues for the U.S. government, that's going to go from around 10% to 40% over the next few decades. This is going to crowd out a bunch of critical things. So if you're talking about, medical, defense, you're talking about the budget effectively getting crushed to cover the debt expenses that have been accrued and will continue to accrue in the years ahead, the continued deficit spending. So this is why it's so critical that we start having really competent leadership Say, okay, this is a red alert problem. This is not something where we can just say, hey, let's lower taxes and spend more. You need to say, okay, we are screwing over the next generation if we keep this up. You need to have some, and not just partisan politics of like, hey, let's do what's great for right now. You got to say, the U.S. government is broke, folks. That's effectively what this is saying. This is the data. Keep in mind, this is data from the Congressional Budget Office. This is what the government's saying. What are the assumptions they're using? They're saying that the cost of their interest rate, the average interest rate on the federal debt, increases from 1.8% in 2022 to 3.1% in 2032 to 4.2% in 2052. Folks, wake up. The 1-year cost of borrowing right now is more than the cost that they're assuming in both 2032 and 2052. These assumptions are way, way off. And this creates the real risk of hyperinflation that Elliott's talking about. Because what happens when you start saying, oh, I have now, instead of $1 trillion in interest expense, I now have $2 trillion in interest expense. And the U.S. government goes, okay, well, we haven't cut back on these deficit spending because that's, like 5% in the economy, which, by the way, if they were just to cut deficit spending, that's 4 or 5% hit to the economy. So you're talking about deep, deep, deep recession. So this is going to be super painful to work through. So how's the government cover, let's say, an extra trillion, 2 trillion? Trillion goes around. Throw out trillions to your friends. How is the government going to cover these extra trillions of dollars of interest expense? Well, ultimately, that means they're going to have to issue more debt. And that creates this sort of debt spiral as investors are going to say, well, wait a second. This is like Ponzi financing. This is what happens when you're insolvent, where you're going to say, wait a second, you need to issue more debt to cover this higher interest expense. So this is going to require a lot of changes to the U.S. system, U.S. structure, where they're going to have to cut back on deficit spending, and they're probably going to have to do some tweaks to the banking system to say, hey, banks, you need to buy more treasuries to effectively help us out. And we'll do some sort of regulatory measure to make it okay for you to own an outsized position in treasury, so where maybe you don't have to market or something like that. But looking at this and what the Congressional Budget Office is saying, effectively they're saying 40% of revenues in the future is going to be committed to interest expense, and that's assuming much lower interest rates than exist right now. This is a real problem. So I think what Jerome Powell's saying is I would rather crush it. I would rather crush the economy now, put us in such a hole that I can start lowering interest rates versus having inflation entrenched, prolonged, and potentially have to do even higher rates a few years from now, in which case the U.S. is in even deeper trouble. That's, I think, what's effectively going on. But this is the risk that Elliott's talking about of like, hey, how do you deal with an environment where you're effectively issuing debt to cover your interest payments? Okay, so what happens from here? How do you position yourself? How is Elliott positioning themselves? What can you do? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. So Elliott had a few different things to say. Elliott's run by Paul Singer and Jonathan Pollock. They effectively said investors should not assume that they've seen everything. Effectively, you may have seen the Rona boom and bust over the last few years. You may have seen the dot-com implosion. You may have seen the crash in 1987. You may have seen long-term capital management in 1998. You may have seen the crash in 1974. This is different. This is not business as usual. That's one of the first things that they're effectively saying. Just because you think you've seen everything, this is not like it. And they also make the point, this is really concerning in all honesty, we will not panic because we have seen this before, does not comport with the current facts, i.e., they're panicking a little bit. They're getting a little bit nervous. Now, keep in mind, they're up this year, when a lot of folks are getting crushed. And so what I think the real take isn't for you to panic, I'm going to sell everything. That's not necessarily what you need to do. What you need to do is have a very analytical approach to say, hey, how will this do in a period of elevated inflation? Let's say inflation over the next few decades is higher. And then you should also consider how will your investments perform if there's a period of, let's say, substantial economic contraction, like effectively what the Fed is pushing the U.S. towards in order to break the back of inflation. Looking at those two pieces, how are you positioned to deal with that? And I think ultimately it comes down to finding exceptional businesses and owning them at the right prices. And we'll talk more about that in just a second. Elliott continues, effectively saying, look, the markets have not yet fallen enough. Equity markets could drop more than 50% would be normal. I agree with that. I've talked about this before. Wouldn't surprise me to see, let's say, the S&P 500 well below 3,000. This is not business as usual. So what should you do? What's Elliott even doing? Well, it's interesting. Elliott's made several large bets on effectively platforms. They bought a stake in Pinterest. They bought a stake in PayPal. Effectively, what they're owning is the platform. They're owning the toll booth. They're effectively saying, hey, we recognize, okay, so if there's going to be extreme, let's say, deflation because the Fed manages to crush the economy, then every business is going to get hurt, except for effectively cash and shorting. Shorting will do really well, and they do have a lot of puts that they also buy. So that is something to be mindful of. This is a different type of environment. But if the Fed ultimately has to start reflating because they've crushed things, like Jerome Powell's effectively saying, I'd rather over tighten and then be able to loosen. I'd rather crush the economy and then be able to lower rates. If that happens and then you get inflation longer term, like arguably you're going to get because the U.S. government is broke and is going to have trouble financing all this debt in the decades ahead, above average inflation relative, let's say, the last 30, 40 years, you're going to have that stickier inflation potentially. Then you're going to want to own the platforms that can benefit from it. Effectively, the financial toll booths that can make money, where you sort of say, hey, there's more inflation this year by 5%. Well, there's more goods being sold on Pinterest. There's more goods being sold on PayPal, that they're getting that cut regardless of what's happening. So longer term, if you're getting an extra 2, 3, 5% inflation, that actually benefits the toll booth business models. My personal take, and for you to consider, is that once again, this is going to be an environment for wealth generation, multi-generational wealth building, but you're going to have to be disciplined and you're going to have to wait to find companies. This isn't just saying, hey, I want to own, this unprofitable growth tech stock. What you're going to want to say is, I'm going to want to find a business with an incredibly strong value proposition. They offer a good or service that is needed and they're taking market share. That's what you want to be seeing right now. And so you're saying to me, in this environment, whether or not it's deflation, whether or not it's inflation, they are offering a critical service so that they can grow over time. So that's the first component. The second component is that if we are in for a period of larger inflation or higher inflation, like Elliott's warning longer term, you're going to want to have free cash flow. You're going to want to make sure your businesses have free cash flow. If you are a cash burning business and there's higher inflation, that makes arguably your cash burn even worse. So this gets back to the first point. You need a strong value proposition. So ideally you're able to pass on the cost with higher pricing, and also the free cash flow. So that way you can invest it in other things that can continue to grow or return that free cash flow to shareholders. So this is the layout. Personally, this is like red alert, looking at what Jerome Powell said earlier this week, seeing what Elliott's posting recently. Red alert, I think investors should be prepared for much better bargains in the quarters ahead. Personally, what I want to find are incredible businesses. And I call, the businesses out that I find to be compelling, at unrivaledinvesting.com. For example, you might want a medical company where, even if there's a recession, even if there's continued, inflation, they should be able to continue selling their goods because, let's say, it's a required product for their customers. Or maybe it's an insurance company where over time they're going to say, hey, these insurance premiums, we're going to have to raise them because, effectively the costs have gone up to insure this thing. So effectively indirect pricing power, and ideally an insurance company that has the capacity to underwrite business in an environment where a lot of insurers have gotten crushed in this environment. So those are the types of things that I'm looking for. So if you enjoyed this video talking about sort of the pain that I expect to continue seeing ahead, where it could actually get much worse from here. And I'm sorry to say that, but view it as an opportunity for you. I don't, this is not saying, hey, I'm happy that unemployment's going up. I am not happy that unemployment's going up. I view that just sort of as a consequence of where the economy is. But view that as an opportunity if you have the cash to deploy to sort of say, hey, I'm going to be looking for wealth, ideally life-changing, multi-generational wealth building opportunities. That's what this challenging period, in my opinion, represents. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.